You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 11th of March, 2024, and I'm joined by my co-host, John McEwen. In this week's episode, we'll be discussing Greggs, ITV, Entain, Darktrace, DS Smith, and our US company of the week is Disney. John, do you want to start us off with Greggs?
Yeah, so Greggs, covered it lots of times before. It's the baker, and it had its full year results out last week with reported full year revenue up 19.6% to £1.8 billion, with like-for-like sales in company-managed shops rising by 13.1%. Revenue growth was driven by 145 net new shop openings and an increase in prices and volume growth. Underlying profit before tax was up 13.1% to £167.7 million. Free cash flow came in at £122.1 million, which was down from the £152.4 million in the prior year, the difference largely being down to increased investment. Like-for-like sales are up 8.2% in the first 9 weeks of 2024, which is in line with expectations, and cost inflation is expected to trend around the 4 to 5% for the next year. The board has proposed a final dividend of 46 pence a share, along a 40 pence special dividend. And the shares are up around 1% in early trading. In terms of valuation, Greggs has a market cap of 2.88 billion and trades at 19.7 times forward earnings with a yield of 2.6%. I thought these were a fantastic set of results against a tough economic environment, and they have adopted, I think, a few smart strategies which we've commented on before. They've increased the number of shops that are franchises now to around 20%, and they took up the deliveries with partners Just Eat and Uber Eats. They've extended their opening hours, so now they're doing evening openings, and they also have click and collect. I suppose the difficulty, whilst a fantastic business, is that it's highly priced at the moment, and you do wonder where the future growth is going to come from. Over the last couple of years, I certainly felt that they weren't that saturated in the south of England. And you, Sam, living in the northeast, the home of Greggs, felt that it was incredibly saturated. So we had different views of where that future growth was going to come from. It has still been delivering, but I think we are getting towards that sort of saturation point. And I think, as you previously pointed out, some of those growth levers that they pulled, they can only pull once. And it is a high valuation. So I probably wouldn't be buying shares now, although, as with a lot of companies, I regret not buying a few years ago. And I remember the first time we covered it, we were pretty pessimistic about it because it was it was sort of during and just after COVID, and you didn't know whether the high street was going to recover. And as we've seen with Greggs, it's recovered fantastically well.
I would agree. I do think, though, now that the forward P is now under 20, which is possibly the first time we've seen it since it recovered from COVID, slightly more reasonable. But I think that also shows the market probably has some of the same concerns we do, where it's now, despite putting up a really, really good set of results, you can't really fault them. Volume up, prices up, new stores. It's below the 10-year average. And I think that does tell you something. Can't knock the performance, but yeah, like you, I would question where the growth's going to come from once they hit saturation. One thing I did think, though, when you're talking about how the results were quite good despite being in a tough economic environment, do you think a tougher economic environment could actually be better for Greggs?
Well, this is true because it's, I suppose, discretionary spending. But if you're not going to prep, maybe you're trading down to Greggs.
Yeah, but no, really good set of results. I'm not sure I'd buy it at this valuation, but I think it's slightly more reasonable than last time we covered it. At least it's under 20 now.
Yeah, and it is a great business.
It is, yeah. We just, if we had a little bit more vision when we covered it in the pandemic, yeah, things would have been different.
Put it in the fantasy portfolio or even our own portfolio, even better.
That would have been preferred to the fantasy portfolio for me.
On to ITV then.
So ITV, a business we haven't covered for a while, they have come out with their full year results and they've reported a 2% fall in revenue to 4.3 billion, with positive performances in ITV studios and digital revenues only enough to partially offset the 15% decline in TV advertising. Underlying cash profit, EBITDA, so no D, fell 32% to 489 million, reflecting the poor performance in traditional broadcasting and continued investment streaming. Free cash flow rose 28.9% to 361 million, reflecting reduced payments to the pension scheme. Year-end net debt was 553 million, which on underlying profits of 489 million, I don't think actually looks that bad now. Medium-term guidance for ITV Studios remains intact, but delays from earlier strikes in America and a weak European advertising market are impacting current trading. In media and entertainment, advertising revenues should rise about 2% in the first quarter. However, non-advertising revenues are expected to be down over 2024. The board declared a final dividend of 3.3p, bringing the full year total to 5p. A £235 million buyback has been announced, and that's going to be funded by the proceeds of the disposal of BritBox International, which they have sold their entire 50% stake into BBC Studios. After taxes and repayment of loans, they should receive 235 million in cash, which represents around 10% of the market cap. And that's what they're putting into the buybacks as discussed. It's a bit weird with the BritBox because that was launched in partnership with BBC a few years ago, and that was meant to be their way of taking on kind of the Netflixes. It hasn't really worked, which anyone who looked at the back catalogue probably could have told them in advance. There's only so many like 70-year-olds that want to watch old episodes of Morse and pay for it. However, for the BritBox, they seem to have given up on it, but BBC have sold their 50% share of BritBox to ITV, who have then just basically turned it into the ITVX, their online offering. So I'm assuming that means you can maybe still get the BBC stuff on there, because otherwise I do wonder what they've paid 50% for, and maybe it's just a name. But then for the international side, they've sold their 50% to BBC. So I don't really know how it works. If you've got BritBox internationally, can you still get all the ITV stuff? I don't know, but for the figures involved and the fact they're out of it, it probably doesn't matter. But it's a bit of a sign, really, that they have given up on that strategy. In terms of the valuation, it trades at a forward PE of 6.6, and that compares to a 10-year average of 10.4. The prospective yield is 8.5%, and that excludes the buyback. The 10-year average prospective yield is 5.3%, so it is cheap, but ITVX is doing quite well, but I would worry about it longer term, because I just think a lot of the people are the people who watch probably ITV. And I think that will be declining and declining as more and more, as the Netflix generation starts to get older and you get the Gen Z start coming through. Because I just I don't pay for a TV license anymore. I just do not watch anything on there. Now, if I was 20 years older, I probably would. And that's my concern with the ITVX demographic, that it is a demographic that's going to age and they're not going to have a newer generation coming in. That being said, it is very, very cheap, and it is actually almost priced like a tobacco stock. And the results aren't that bad. It's not for me because I don't really want a declining business, albeit slowly. But I think you could make a decent argument for owning this based purely on valuation. Because if it doesn't decline as much as people were expecting, or if ITV Studios can offset the decline in TV advertising, it's maybe not too badly priced. What do you think, John?
I don't like it. And I think all of those points about it being a business in structural decline, and if it doesn't do as badly as people think, then maybe you do all right on it. I don't like that argument in general.
I don't think Love Island could be as addictive as cigarettes to some people.
It's not one for me, Sam.
Right, that's fine. Shall we move on to another one that's not for you?
Yes, okay. This is a growth business, even if it isn't one for me. So it's Entain. It's a big gaming company based here in the UK, but it's been expanding into America, and that's what's drawn a lot of investors' attention more recently. Anyway, they had their full year results out, with the group seeing its full year net gaming revenue rise 11% to £4.8 billion, excluding the effect of exchange rates and the BetMGM joint venture in the US. And that reflected an 8% rise in retail and a 12% rise in online. Underlying EBITDA rose 1% to £1 billion, which reflected higher costs. BetMGM reported net gaming revenue of $2 billion, and that was an increase of 36%. And underlying cash profit was positive for the first time in the second half of 2023. The number of active online customers rose to record levels, which was up 23% on last year. Underlying net debt increased from £2.9 billion to £3.3 billion, and that was impacted by the continued spend on acquisitions. Free cash flow fell from £428 million to £188 million. The group guided that regulatory headwinds could negatively impact on cash profit this year by around 40 million. And a dividend of 8.9 pence per share has been announced, bringing the total for the year to 17.8 pence per share. And shares were down around 3.5% following the announcement. In terms of valuation, Entain has a market cap of £4.69 billion and trades at 17.9 times forward earnings, compared with a 10-year average of 14, with a prospective dividend yield of 2.2%. I thought these were a decent set of results, although there is more regulation, and that's particularly in the UK and Germany. And one example of this is increased deposit limits for gamers. I think it does seem sensible for the group to focus back on the organic growth and ditch some of the non-core markets like Chile and Peru, and focus the investment on the higher growth areas like the US and Brazil, and then the core regions like the UK. It's not an industry I would invest in. I don't like gaming and gambling. However, I think if you were looking at the UK gaming and bookmakers, this is probably the one that looks like it could deliver the most growth. And you can see it in the valuation. It's more expensive than its 10-year, considerably more expensive than its 10-year average. And it is focused on the venture in the US with BetMGM. And that is now working out for the business. I mean, it was delivering revenue growth pretty rapidly over the last couple of years, but now it's actually turned profit. And I suppose that is where things are focused. Drawbacks, I guess it is, well, the ethics, but also the regulation of it. And if you saw stricter regulation, and particularly if you saw it in the States, it could really impact, and it's got a lot further to fall than it did have previously. And it's not a company that's priced like a tobacco, fellow kind of sin stock in that sense. That's probably all I'd have to say on it. But it looks like it's the one of the UK bookmakers that's essentially priced more and delivering more growth than any of the others. Sam, what are your thoughts on Entain and these full year results?
Very similar. It's not a business I'd be interested in, but then I know we say it every time, but I think, if they can crack the US, it's not that expensive. And, what they are reporting from the US does look very promising. Revenue, net gaming revenue up 36%, cash profits positive for the first time, record active customer numbers. It does seem to be moving in the right direction. And I think at 17 times earnings, if you don't have any ethical objections to it, I think you could potentially do very well. I think it's putting up some really good figures. I do question, though, like you say, I agree that, they should be focusing on the markets with the better opportunity, like the US. But I just think, when they've had this such great opportunity in the US, why are they messing around in Chile and Peru anyway? Why are they not just going all in on the... I don't get why that's even had to happen in the first place. But anyway...
Yeah, it'll be interesting to see historically how long they've had those positions for, whether it kind of predates all of the BetMGM.
I hope it does.
You would hope it does, and I would imagine it does, because you can't see the logic in it otherwise.
No, but anyways, I think focusing on anything that increases a US focus can only be a good thing, especially with the results that it is putting up. But yeah, I think it's pretty reasonable given the kind of figures it's delivering for the US business.
Fine. Okay, on to a more expensive business.
Yes, so Darktrace. It's a business we have covered before, although I think only once. For anyone who's not familiar, and this is from their own website, so do take it with a pinch of salt, but Darktrace is a world-leading provider of AI for the enterprise, with the first at-scale deployment of AI in cybersecurity and a pioneer of autonomous response technology. Created by mathematicians, our platform uses machine learning and AI algorithms to neutralize cyber threats across diverse digital estates, including the cloud and networks, Internet of Things, and industrial control systems. Our self-learning technology requires minimal setup, quickly identifying threats that have breached the perimeter, including threats exploiting previously unknown vulnerabilities and insider threat. With deep expertise in mathematics and machine learning, as well as operational experience defending critical organizational assets, Darktrace seeks to empower enterprises to defend their systems against the most silent and sophisticated cyber threats. Darktrace currently serves over 9,230 customers in over 110 countries with more than 2,200 employees globally, and they are headquartered in Cambridge, UK. So they have come out with their half-year results. We've said that their performance track in the first half of the 2024 financial year supports what they believe is a change in trajectory following a period of transformation and stabilization, moving to net constant currency annualized recurring revenue added growth in its second half. The revenue was up 27.4% to 330 million. The gross margin was pretty similar, down slightly from 89.7 to 89.3%. Net profit was up 8,939% to 52,518,000. Adjusted EBIT was up 118.9% to 70,977,000. Adjusted EBITDA was up 87% to 84,518,000. And net cash from operating activities was up 142% to 65.5 million. They reported strong year-over-year revenue growth across all geographic markets and customer sizes. Gross margins broadly stable, and they've said that's on the prior period, reflecting consistent contract economics. They said the adjusted EBIT margin improvement of 9 percentage points reflects continued scale efficiencies, ongoing discretionary cost management, and year-over-year a more favorable foreign exchange environment. They've said they've had period-over-period decreases in sales and marketing as a percentage of revenue, 15.3% period-over-period increase in R&D cash employment costs. They've said the net cash inflows from operating activities, which increased from 38.5 to 65.6 million, was primarily driven by an increase in period-over-period net profit, partially offset by a decline in net working capital, reflecting the move to monthly commission payments for 2024 onwards from quarterly commission payments in prior periods. In terms of the operating performance, the annualized recurring revenue at 31 December was up 24.4% to 702 million. Net annualized recurring revenue added was down 10.8% to 64.8 million. 1 year gross annualized recurring revenue churn was pretty flat at 6.6%, up slightly from 6.5%. Net annualized recurring revenue retention rate was pretty flat at 105%, down slightly from 105.1%. Number of customers was up 12.9% to 9,232. And the remaining performance obligations in US dollars was up 12.2% to 1.253 billion. In terms of the valuation, the business trades at a market cap of 3.05 billion. And I think it actually now has earnings. It's got a PE ratio of about 32. If you look at the financials since it listed in about 2020, revenue's up from 199 million in the year ended 30 June 2020 to 545 in June 23. And then for the first half of 2024, they're already up 27.4% for that half to 330. So this is a company that is delivering the figures. I thought these were they look like a really good set of results. It is with a caveat that it's a business that I really struggle to understand. Quite skeptical as it has the AI buzzwords all over it. It did have all those before AI was as much of a buzzword. I think if it can continue putting up these kind of results, if it can continue getting the economies of scale that we're starting to see coming through, and it can continue to retain its competitive advantage that it thinks it has from its AI and what it's doing, I think at 32 times earnings, it could actually be quite cheap. I think it's the kind of business where I do look at it and I do think, why didn't they list in the US? Because I think if this business was in the US with these kind of figures, we would be talking about its valuation as multiples of revenue rather than earnings. So I do kind of question the decision to list in the UK. However, as outstanding as these figures are, I don't really understand what its competitive advantage is. I know it sort of tries to tell you on that information page, but I am just having to rely on what they say. I've got no way of measuring how easy it is to retain, and it just goes in the too hard pile. But it looks like for someone who understands it, it could potentially be a very, very good business. John, what are your thoughts?
Similarly, I think I'd echo that. It's not one that I understand, but it does certainly look like it's delivering. Yeah, the moat, competitive advantage, very, very difficult to stay. I think you'd have to have that technical expert knowledge to be able to give a proper analysis on it. Yeah, and listing in the States, yeah, they'd probably be double, if not triple, the valuation.
Although I do have concerns about the fact I kind of don't understand it. I think actually the results are that good. I think I possibly would buy it if it was cheap enough. But the problem is it would have to be so cheap to compensate for the fact that I have no idea what I'm doing, that I'm just never going to see those kind of valuations, that kind of valuation for a business putting up these kind of numbers. But it looks really, really impressive.
Yeah.
But then it's something where in like 5 years, would it just be completely redundant because someone else has found a way of doing it even better? And that's the concern. I think you have to be in the industry to really be able to have a proper analysis of this.
Either that or an acquisition, which, could make you quite wealthy.
Yeah.
If it's as good as we think it is, or, might be.
Should we move on to an easier business to understand?
Yeah. So moving into the world of cardboard boxes, DS Smith had their Q3 results out, with the group reporting flat for like-for-like volumes in corrugated boxes in the third quarter. Growth in North America and Eastern Europe was offset by a weaker performance in Northern Europe. And focus remains on improving operating efficiency and managing anticipated raw material price increases. Volumes are expected to grow moving forwards, but the market does remain challenging. The big news, though, with DS Smith is that Mondi have come in for DS Smith, and they've released a joint statement with further details on a proposed acquisition by Mondi. The proposed deal is to be structured as a combination, with DS Smith shareholders receiving a 46% stake in an enlarged Mondi business, and this implies a value of £3.73 for DS Smith shares. 3 non-executive directors of DS Smith are expected to join the enlarged Mondi Group board. It's still not a firm offer, and Mondi has been granted an extension, and it now has until the 4th of April to make a firm offer. It's roughly a 33% premium to what it had been trading at before. And in terms of its current valuation, even given that premium now, DS Smith has a market cap of £4.72 billion and trades at 9.8 times forward earnings, with a prospective dividend yield of 5.7%. I think it's a difficult one in terms of whether this is truly offering value for DS Smith. I'm not sure. It's certainly, in terms of its share price, it has been a lot higher, and where we are in the cycle and higher energy costs, etc., have really depressed the price of DS Smith in the last 18 months. And you do see it as quite opportunistic. I think I'd have to go back and look at Mondi again to see whether you're really getting value out of this if you're a DS Smith shareholder. I'm not sure. I think that the results themselves are fairly lackluster and do represent that tough environment. So I'm a bit on the fence with it. But saying that, I think the last few times we have covered DS Smith, it has looked particularly cheap, and we've both had a little think about whether we take a position, but neither of us have.
I don't really have. Where's Mondi listed? Are they listed in London?
Yeah.
Oh,
let me fact check that. Have we not covered them?
We've never covered Mondi.
Okay. Yeah, they are listed in London, and they've got a market cap of about 6 billion. So
pretty similar size.
They're not. Yeah, and I suppose that's 40. Yeah, receiving 46% stake in. So I guess The
thing is, if they're similar size and you're buying one at like a premium, is it the best strategy? But I don't know how I feel about this, because the thing is, it's like if you look at like the share price over 10 years, like £3.75. It's not terrible, but it's a business that has actually very briefly traded over £5. and less briefly, it has, on occasion traded over £4. I think 375 though is probably at the higher end of like where it usually has been trading in the last 10 years. I know it is a cyclical business, so you're going to get some quite nice dividends depending where you are in the cycle. But then, I don't know. I don't know if I think realistically, if you're a shareholder, your decision's not really like, am I getting the best deal here? Because you're probably not. It's more, is the combined company more likely to get economies of scale and do better than DS Smith on its own? I think that's probably where the opportunity is. It's not in the premium you're going to get for DS Smith. It's for what they could potentially do as a combined entity. Yeah, I don't know how I feel about this. I do like DS Smith. I guess we'll have to start covering Mondi to keep an eye on it. I don't know why we haven't covered it, but DS Smith has always been the Investor Way's favourite box maker.
Yeah. Okay. Well, watch this space. Disney.
Yes. So these results are about a month old, but we can't not cover them. So we've come back round to them because I think they might have come out the same week as PayPal. So I think we did that instead. But Disney have, a month ago, they have come out with their Q1 results, and first quarter revenue was flat at $23.5 billion, and all these figures will be in dollars. Within entertainment, there was a 7% decline, and that was led by traditional networks and content sales. The direct-to-consumer business, which includes Disney streaming brands, saw a 15% increase. This included the effect of price rises, offsetting the expected decline in Disney Plus subscribers. There was a 35% revenue increase in the international theme parks, helping experiences revenue rise 7% overall. Operating profit was 27% higher at $3.9 billion, which reflected narrowing losses in the streaming business. There was free cash flow of $886 million compared to a $2.2 billion outflow in the previous year. Disney's on track to meet or exceed $7.5 billion of annual savings by the end of 2024. And they've also announced a $1.5 billion investment to acquire an equity stake in Epic Games. If we drill down in a little bit more detail, they've said that Hulu subscribers increased 1.2 million from the prior quarter. Disney Core decreased by 1.3 million in line with the guidance, and that's reflecting a substantial price increase, as well as the end of the global summer promotion. Average revenue per user increased sequentially by 14 cents versus the fourth quarter. And they expect Disney Plus core subscriber net additions between 5.5 and 5.6 million, and ongoing positive momentum in the average revenue per user in the second quarter. So in the direct consumer, as mentioned, that revenue is now up 15% to 5.5 billion. The losses, so last year it had an operating loss of 984 million on 4.8 billion of revenue. That's down to 138 million on 5.5 billion. So I think within the next 12 months, we start seeing this profitable, which is obviously what we're wanting. Paid subscribers, Disney Plus. I mean, I know it's a slight decline, but it's really slight. So Disney Plus core is down from 112.6 to 111.3. Disney Plus Hotstar, that's up 2%, but that's the Indian one where they don't really get anything. But then again, the subscriber average revenue per subscriber, that's up 9% now to $8.15 in the US and Canada. And that's up from $7.50. But the Disney Plus Hotstar, which actually increased subscribers, that's up 83% revenue per subscriber from 70 cents to $1.28. In terms of the valuation, the business trades at a forward PE of 21.7, and that compares to a 10-year average of 23.4. And the prospective yield over the next 12 months is 0.8%. I'm pretty happy with these results. I think since Iger's come back in, I think he's done a good job. I think the fact they're getting the cost savings early and they've got them that easily without any real negative impact on the results, I think is a good indicator of just how much bloat there was in this business. And there's probably still quite a lot. I don't know how I feel about the Disney Plus. It would be nice to see it turn into profit, but my philosophy has always been just getting many subscribers as you can. That being said, it's like 4 years old now. So at some point you do actually have to start monetizing them. And the growth, despite the fact the fees are relatively low still compared to competitors, the growth has slowed anyway. So I think maybe it is time to start tapping into the pricing power. It is good to see how much the losses have been slashed because they were possibly making probably more content than they needed to, given how high the quality of the IP is. So I think overall, I think I'm pretty happy with this. And, the share price reaction also suggests that a lot of other people feel the same. John, what do you think as a fellow shareholder?
Yeah, no, I would agree. And I think you are seeing Bob Iger coming back and the turnaround working. I'm optimistic. And I think, yeah, next few quarters, fingers crossed, and we'll see. I agree with you in terms of the streaming business. It does need to start delivering profits, but there is a lot of potential there, and they haven't pulled all the levers that they can with it.
The thing is with the international ones, they are just worth less anyway, so you can only increase them so much, but some of them are just so low. I mean, it's like with that Disney Plus Hotstar, they've increased it 83% and subscribers have gone up 2%. I think that tells you it's very, very underpriced still.
Yeah, even for the markets that it operates in, or India, I suppose.
So I'm pretty happy with it. Of the six businesses then that we've covered this week: Greggs, ITV, Entain, Darktrace, DS Smith, and Disney. Which do you like the most and which do you like the least? You can do it including and excluding Disney.
Okay. As a business, Disney, hands down, and it's the one that I own. In terms of the results that they've put up this week, it'd either be Darktrace or Greggs. I'd be closer to Greggs just because Darktrace, it's a business that I don't think I could ever understand, and I wouldn't take the risk for that reason. And yeah, DS Smith, I don't know enough about Mondi. Entain or ITV would be bottom of my list. I'd probably sum it up like that, Sam.
I think my top would be Disney, excluding it, because otherwise it's just always going to be Disney. I probably would also go with Greggs. I think they're a really, really good set of results. I think although we've got concerns about the valuation, I think at under 20 now, it's not outrageous. It's not eye-watering. I think you need to have quite a lot of belief in how much growth they've still got ahead of them to justify it. But I think given the results they're putting up, I do like it. Like the least, if I said Entain, it would be a bit lazy because that's mainly just the ethics of it. It does look like a good business. I think I'd probably just have to go with Darktrace by default because as good as the results are, I just would not be comfortable owning it. And I'd definitely be more... I would sleep better at night with ITV in my portfolio than Darktrace. Even though Darktrace may be a better business and does look like it is.
Okay, well, on that, I think we'll end and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.